Welcome back to Income Trading 101. Today is March the 8th, 2021, Monday, March 8th, 2021. And today we're going to take a look at the triple Qs. This is the NASDAQ index. In fact, it is supposed to be literally 1/40th of the NASDAQ. Back in the day, I traded options at the CBOE, and we used to trade the mini NASDAQ, the NASDAQ, and the Qs in an index arbitrage group, meaning that we would constantly seek to find the lowest volatility that's pricing in the market and buy it in that pit and then sell it in the others. And the triple Qs were a favorite amongst people who wanted exposure to the NASDAQ without having to buy like a futures contract on an index or something like that. So let's go ahead and just take a wider look. I'm not going to keep this, but NASDAQ is going to have a very high correlation or beta to the way the Dow Jones Industrial Average as well as the S&P 500 have gone. This is a sort of a large market index, but this is a technology-driven market index. So it should be a little higher. We could take a look at that later on, but in general, you're going to get an upward trend, which is what we're seeing in the Qs. So let's go ahead and take this back. I'm going to start it just after the dip of last really a year ago, the pandemic that happened when we saw the markets finally react in February, kind of bottomed out in mid-March and have been on a tear for the last year. So I'm going to get rid of the volume and go ahead and add in my moving averages the way we always do it here at Income Trading 101. And for those of you that do follow, the larger indices, this is going to have, such a high beta to it, a high correlation to both the S&P 500 and the Dow Jones Industrial Average. But that being said, I figured it'd still be worth taking a look and just seeing what's going on here, and we could take a look and see if these are outperforming or underperforming the other indices. So I immediately shrunk it down. I'll take it back to where it was. So there you have it. It's a long period of a clear upward move. We've had some congestion where you had the moving averages out of line, and then really this period from back in, we'll say, mid-November through the top in mid-February, mid to late February. We just saw another just pure up move in this industry or in this index. Now, right now, we've got a period of consolidation or congestion where the 10-day has already dropped below the 60. The 20-day will probably follow shortly. Now, remember, the 10-day is going to be the most fickle, but if we continue this downward move, we're definitely going to see the 20-day in this scenario follow suit, and we'll drop it to a lower time frame. I expect those lower time frames to be bearish. What's interesting here, of course, is that on this 1 hour chart, the 10 is actually pulled a little higher and appears to be heading back lower. Once it does finish or head back lower, you'll have a scenario where the 10 period, the 20 period, and the 60 are going to be in line. But right now, they are out of line with even a little bit of congestion. The 20 and the 10 are quite close in the 1 hour time frame, and I wouldn't look to trade off of purely that. You can see at the 30-minute time frame, the 10 period has already moved below. So in this scenario, you have all three moving averages in line and appearing to start to really point towards a short-term move, or move in the shorter time frame. When we take it to the 15-minute, that's no surprise at all. Actually, I'm somewhat shocked. I would have expected the 60 to be a little bit higher than the 20 and the 10, but even at this level, they are fully in line. So, but overall, I'm going to say that these moving averages, because even in the scenarios where all three moving averages are in line, they're so close that one day or one tick of one additional data point could really change the direction of these moving averages. That's part of what makes trading off of moving averages so difficult. You really need to give it enough space to breathe so that it can clearly point to a defined move or a defined trend direction, which is the reason we look at this is for analysis of a trend, or at least visibility, hoping that it's visible. So let's go and kick over to the MACD. And I think at the daily level, the MACD might be a little bit less helpful, but I'm certain that in some of the other time frames, it very well might be. And look at this. Actually, at the daily, it's not too bad. I was more worried about the MACD effect of this long-term trend up, and you can see how it responded. But we did back in February get a nice crossover in the overbought category, and it's since fallen below the zero line. Really, you're almost too late to catch it. I mean, it's not too late necessarily to catch it, but it does. I mean, the move has definitely happened, and if you were trading using the MACD, you definitely could have caught a good chunk of that. Let's take it to a shorter time frame and see if it's also looking bearish or more bullish. So in the shorter time frames, so this is the 1 hour, you see that we've had actually a crossover below the zero line, which would lead to a buy signal. But we right now are super congested. These lines are, the MACD and the signal line are very close to each other. It's not something I would trade at that time frame. And on the 30-minute, this is not a clear. This here that this crossover that happened in March for a buy would be more bullish, but the fact that the momentum never went higher than the signal, never went higher than the zero line, and it pulled on back. This is exactly what it looks like when you have the continuation of a downward trend or an upward trend, which means that the move has already happened and you might actually be too late to catch it. But keep your eyes open as well. When you take it to a shorter time frame like the 15, you can catch all sorts of stuff. It really becomes a matter, like you can see here how a crossover would have happened, back here on around the 1st of March, and we fell below the zero line, and we went above the zero line, but now we're back below it. This is the way it looks when you're in a downward trend, and it makes it difficult right now to look at this and say, yes, this is a definite sell. Because I really don't see this as being conclusive enough. But going back out to the 1 day period, we're going to get rid of this. Not really all that interested in Fibonacci analysis in this scenario. What I am interested in is the way this current level has played both support and resistance. Let me just draw a line just to make it a little more clear. I mean, check that out. Resistance back in September, almost got there in October. Resistance again back in November. Support in December. And now we're right at that line. Right at that point again, and we'll have to decide if it's going to act this time as support, like will there be a rebound from here, or if it's going to be a period of resistance. And you know what? I will take a little moment to go ahead and do a little Fibonacci analysis as well. We're going to do it on an on a shorter term move though. I'm not going to take it, I don't think, on the full move because of the level of pullback that we saw for part of this too. So I took it from the low in early November all the way to the high that we saw in mid-February, and it looks like we've gone more than 50%. We're almost at the well, we're approaching the 61.8. We're between right now the 50% and the 61.8% retracement of that move. Let's do something else. We're going to take it over over this larger move. Just doesn't even seem right, given that, this was a recovery from a pandemic. But just so that we look and see. So what I see as interesting is the fact that if I really wanted to try hard, I could have matched the current level with the 23.6% level in Fibonacci analysis, right? That also lets me know that we could easily dip down to 272.33. All right, look at what's happening at that level. So that would be the 38.2% return of this larger move. We had support in that area back in late October, early November. We had resistance in that area back in late September. We also had a little bit of resistance in August. So that'll be something to keep an eye on. Really seeing whether or not this is going to, or when this is going to pull back higher. But it's definitely, like I said, it's something to keep track of. Before we go, let's do a little comparison just so you guys will see what I'm talking about when I talk about high beta or whatever. We're going to overlay this with the S&P 500 ETF. Pull that on in. So look at that. By magnifying a bit so the time frames were a little closer on top or a little more visible, you see that this index really does track well with the S&P 500, and a good part of that is because the components of the triple Qs are also significant components of the S&P 500 index. So oftentimes people will say like, oh, I have, the triple Qs for some technology exposure, and I have the S&P 500 for general index exposure. And what they don't realize is that the S&P 500 is heavily weighted in tech right now because of the significant gains that the tech companies have had in the last year. So that's why these will look very similar with regards to their percentages and the returns over the course of the year. So it's always important to know what is actually in an ETF before you put your money in there, ideally before, because you might just be doubling up on the same companies and not truly getting the diversity or the diversification that you're seeking for your assets. So anyway, that's going to be it for tonight for the show today. Thank you guys so much for watching. Definitely click the like button and click the subscribe button if you haven't already subscribed to our channel. We are growing in base, and it's just awesome. So thank you guys so much for watching, and happy trading. So long.